Warren Buffett, otherwise known as the Oracle of Omaha, is a legendary value investor who transformed a struggling textile mill into what would become the highly successful holding company Berkshire Hathaway. He was born in 1930 in Omaha, Nebraska, and he showed an early interest in making money by selling soft drinks and investing in land. After attending the University of Pennsylvania for a short period, he transferred to the University of Nebraska, where his father encouraged him to pursue a graduate degree that led him to study under Benjamin Graham, the pioneer of value investing at Columbia University. After graduating, Buffett initially struggled to find a job in the financial industry, but eventually joined Graham in New York. Unlike his mentor, Buffett looked beyond numbers and emphasized the company's management and competitive advantage in the market when considering investments. In 1956, Buffett returned to Omaha, launching Buffett Associates, and eventually teamed up with Charlie Munger. Together, they developed an investment philosophy that focused on the long-term value of business rather than short-term profits. They acquired Berkshire Hathaway, a textile mill, and used its cash flows to invest in other companies. The original textile business was eventually overshadowed by these investments. Buffett isn't only a wonderful investor though, he's also great at saving money and budgeting. This is why today we're going to talk about 8 rules to follow when you get paid, brought to you by the legend himself, Warren Buffett. Hello and welcome back to Tide to Wealth, where you are just one sale away from reaching financial success. Prioritize savings. Buffett is worth around $100 billion. He could clearly spend like there's no tomorrow, but the guy is notorious for being extremely spendthrift. This is the same guy that eats McDonald's with coupons. Buffett has emphasized creating financial security, and he also happens to be a big fan of saving money properly. Now, you might think, what's the point of saving in times of high inflation? Well, it's more important than ever to save. The biggest mistake is not learning the habit of saving properly.
Let's ask who is the more frugal between us. Charlie, who do you think?
Well, in personal consumption, Warren is more frugal.
Warren emphasizes the power of habits in financial success. He points out that the impact of habits is often not felt until they become too burdensome to change. To make wise financial decisions easier, he says that automating your savings by setting up regular transfers from your paycheck into your savings and retirement accounts. This ensures that you save consistently without relying on willpower. Not only does this help you save first and spend later, but it's a philosophy that's extremely dear to the investor. Buffett also advocates a unique approach to spending. He advises not to save what's left after spending, but spending what remains after saving. This means prioritizing savings and investments before spending on other expenses. Buffett's investment philosophy is also based on the principle that the price you pay for an asset should match its underlying value. He believes in purchasing high-quality assets when they are available at a discount. Whether it's buying socks or stocks, he prefers acquiring quality items when they are marked down in price. The current market conditions might sound really bad, but they offer opportunities for consumers, as stocks and various items are available at lower prices due to market fluctuations and excessive inventory. Inflation has prompted consumers to reduce their spending, creating deals in the market. Have an emergency fund. Warren Buffett says that it's absolutely crucial to maintain a cash reserve or emergency fund. In his company, Berkshire Hathaway, having a cash fund serves as a risk-lowering strategy against unforeseen events that could harm the company. On top of that, as an investor, he holds cash in times of bull markets, making sure he's prepared to seize opportunities in bear markets. Back in 2013, Buffett gave a speech at the University of Maryland, where he shared his perspective on the benefits of holding cash. He mentioned that Berkshire Hathaway keeps $20 billion or more in cash on hand. While this might seem excessive, Buffett stresses the importance of this precautionary measure, noting that someday in the next 100 years, when the world stops again, we will be ready. There will be some incident, it could be tomorrow. At that time, you need cash. Cash at that time is like oxygen. When you don't need it, you don't notice it. When you do need it, it's the only thing you need. As a guideline, an emergency fund should be enough to cover your essential household expenses for 3 to 6 months. So, if you're looking to create an emergency fund, then what you need to do is calculate the total of non-negotiable costs like food, gas, mortgage, insurance, utilities, etc. Multiply this amount by 3 or 6 to determine a reasonable initial target for your emergency fund. Then you should create a dedicated account at your bank titled Emergency and make a pact with yourself and your partner that this money is exclusively reserved for genuine emergencies. As the financial advisor Dave Ramsey says, your emergency fund is not an investment, it's insurance with one purpose: to protect you and your family. So, when should you dip into your emergency fund? The rule is straightforward. If an unexpected and urgent event arises, cannot be covered from your regular household account, and cannot be avoided, then it's appropriate to use your emergency fund. Building an emergency fund might be challenging for most of us, but by evaluating our spending and saving habits, we can steadily gather enough money for the financial safety net we'll rely on when the need arises. If your circumstances allow, there's no time like the present to start. After all, as the saying goes, you never know when the day before is the day before. Prepare for tomorrow. Now, here's the problem. Everyone doesn't know that it's crucial to save money, and that it's crucial to have an emergency fund as well. The reason why people haven't been able to do that is, excuse my French, because they suck at budgeting. Warren Buffett believes that it's super duper important to budget. Otherwise, you're not really going to end up anywhere. Budgeting. When you're budgeting, think of the 50-30-20 rule. Now, we covered this in depth in an earlier video, so make sure to check it out once you're done watching this. But here's the gist of it: 50% for needs. This portion of your budget should cover essential expenses necessary for your survival, such as rent or mortgage payments, car expenses, groceries, insurance, healthcare and utilities. If your spending on needs excesses 50%, it's essential to make adjustments in your lifestyle, like downsizing or finding cost-effective alternatives. 30% for wants. The wants category includes discretionary expenses that enhance your lifestyle but are not vital. These expenses can be optional, like dining out, entertainment, or luxury purchases. Making choices that align with your priorities can help you manage this category effectively. This also happens to be the category where you can make the most difference, considering that most people spend over 30% on their wants. However, there's also a fine line between wants and needs. For example, you need food. However, do you need to go to the Whole Foods and get the most expensive items, as compared to what you'll find at Aldi? This is where you need to be a little smart and figure out where your needs end and where your wants begin. Lastly, 20% is for savings. Allocate 20% of your after-tax income towards savings and investments. This portion is critical for building financial security. Start by creating an emergency fund to cover unexpected expenses or job loss. After that, focus on saving for retirement and other long-term financial goals. Examples include contributing to a retirement account, investing in the stock market, or paying down debts faster than the minimum payments. By the way, if you're enjoying everything in this video so far, would really appreciate it if you could just like and hit the subscribe button. Paying off your debts. Now, this is really important if you want financial success. It's the best way you can protect yourself, especially in the middle of a recession. It's not just Buffett who believes that it's super important to pay off debts. Entrepreneur and billionaire Mark Cuban emphasizes the importance of paying off high-interest debt, particularly credit card debt, as the best investment individuals can make. He breaks down the concept using straightforward math, highlighting that by paying off debt with an interest rate, you essentially earn a return equal to the rate of the loan. For example, eliminating a student loan with a 7% interest rate is equivalent to making 7% return. Cuban says that this approach is a safer investment than stocks or real estate. Once you've cleared your high-interest debt, you can consider investing the money you would have used for debt payments in investments like the S&P 500, which historically offers an average return of around 10%. Considering the typical interest rates on credit card debt, which can be as high as 24%, It's really important to pay it off before you can start spending on frivolous items and investments. However, if you pay the credit card in full every month, then it can actually be extremely beneficial for you, considering that you get cashback and a ton of other rewards. If you're someone who just can't seem to stop spending like crazy, then yeah, it's a better idea to just cut up your cards, pay them off, and then never ever use a credit card again. However, if you do have self-control, then a credit card can be really good for you. Once you've paid it off, then you can start investing and growing your wealth. Well folks, with that said, let us know in the comments what you think is the best thing to do the second you get paid. See you next time.